break-even points do not matter when taking policy loans. But
Yes.
break-evens do matter when it needs to be designed properly in looking at lost opportunity cost.
Hey everybody, welcome back to another episode of the And Asset Show. I'm here with my co-host, the Dominator.
What up, Caleb?
And we're just serious, goofy.
We gotta have a little bit of fun.
Yes, and we're going to be talking about break-evens. And I have a video that I'm not sure is published quite yet, but I essentially say that break-evens in a life insurance policy don't matter. Now, I'm going to correct myself, and then we can have a dialogue. And this is why the show is we're having the show so that we can have a conversation. Is once you have your policy and you design the policy that you want, your break even doesn't matter as it relates to when you can take a loan, because you're basing off of like a long-term result. So you can take loans in year 1, 2, 3, 4 on a life insurance policy, and taking a loan doesn't necessarily matter when your break even is. After making that video, I was like, man, that could be taken out of context, and people are like, break evens do matter when we're designing the policy. And so it's just a conversation around how important are break evens, how important should people take break evens as it relates to a life insurance policy, and then let's just flesh this out, because I do think break evens are really, really important when you're shopping for life insurance, and they're less important when you find your right policy. Like, the only reason a break even makes sense is if you're going to cash out, which does make sense if you have the right policy. I don't know if that makes any sense, but that's the episode topic that we're going to talk about today.
Yeah, when I first heard the video that you did, I was listening and I was like, Caleb, like, I don't know if I necessarily agree with what you're saying completely. Like, the break-even point to me does matter, specifically because two things happen. Is one, it kind of can show somewhat of an efficiency of the way the policy is designed, but also we talk a lot about lost opportunity costs, and we want to be able to recapture that as best that we can. And if my policy, you specifically said actually in the videos, like, it doesn't matter if your policy breaks even year like 5 or 6, or if it breaks even year 30.
Not true.
That's not true what you said?
No, you misheard me.
Oh, okay. We want to replay back the video.
We can.
We're going to replay back it, and hopefully this little piece, we're going to find it and listen and just replay it. So
you're going to be wrong.
No,
but that's okay. I like being right. Here's the thing. We'll put that in. We'll put that in.
I'm saying you said that, but I know exactly what you meant. All right. So,
well, if a policy doesn't break even until you're 30, you got the wrong policy.
Well, yeah, exactly.
What I meant and what I did say in this, we can put this video in the show notes. Everyone's going to be watching it after. And please come for me. Comment in my defense. I said taking loans. I said whether you're taking a loan in year 1, year 5, or year 30, when we're taking loans.
Maybe I heard you wrong then.
Right. When we're taking loans, it still matters. Like, when you take a loan year 1 versus year 30, it still matters. The activity that you do that loan needs to be greater than the cost of capital. It's what we teach. When it comes to break even, though, you don't have to wait till you break even to take a loan. Break even, literally, once you have your policy, only matters if you cash out. Because if you cash out in year 4, and your break evens in year 5, you literally have less money. That's not how this whole thing was designed. And you can make the argument that you're worse off. What you're saying is opportunity cost, which is essentially saying every year that goes by that you have less access to capital, that's a downfall. And I would agree with you, but that again goes into the deciding on the policy.
Okay, so for a summary, to be clear, break-even points do not matter when taking policy loans. But break-evens do matter when it needs to be designed properly in looking at lost opportunity cost.
When it comes to break-even, what should someone know? Like, obviously, we're hoping that people like, oh, yeah, we'll work with BetterWealth, and like, yeah, we'd love to work with you guys. But like, let's say they're not. When you're shopping around, what is your 2 cents as it comes to break-even? And let's talk about front-load policy, and let's also talk about just a regular annual cash flow policy. Like, what are some guidelines? Because it all depends on your age, health. But like, if someone's like, oh, this is a great policy, but it's breaking even in year 15, we're like, I don't know. I think you can do better. So what are the guidelines, my friend?
Yeah, and if we were just looking at just strictly the guaranteed side of things, because the guarantees in whole life insurance are not necessarily the most attractive, but they are awesome to know that you have those involved. You can see a policy actually break even between years 12 and 15 if the policy is designed right and with the right company. So if you're seeing a policy that has paid up additions, dividend, all of those different factors involved, and it's taking 12, 15 years to break even, then you know the policy is probably not designed properly. But specifically, like Caleb mentioned, there are factors that involve that dictate the break even point, which is going to be your age, your health, your gender, the way the policy is designed specifically. And so I see anywhere essentially from years 4 to 8, essentially based off of those factors from the break-even standpoint. And it's also going to depend on company, because there are some companies that are very advantageous from a front load, the beginning being more cash value earlier on, but later on they may not be as advantageous like long term. So you have to see from the give and take of, do I want more cash value, a few percentage points here and there at the beginning, to long term, not be as advantageous? Or am I willing to see my policy break even like year 6 and not year 4, but I will get like long-term performance that's going to be very advantageous for, higher cash value growth long-term. So there's a lot of different factors that are involved. Different companies have different products. Some companies specifically will do that, where the company will have a higher performance earlier on just based off of higher cash value, but then it hinders the long-term performance of the policy as well. So there's just so many different factors. And like Caleb mentioned, who said, hey, like, what does a front load do to a policy? Typically when you do a front load and it's with the right company, and the front load for us is essentially saying, hey, we're going to put more cash value or more cash in the first year than we do all the other years after year 1. So I put $100,000 in year 1, and then every year after that, I put in $50,000. When you typically do that, you have more cash value earlier on, and you typically will see an earlier break-even point as well. So I hope that gave a good understanding of, what to kind of look for from break-even point. When is it no longer good? When is it no longer bad? What the factors involved into it as well.
It's fair to say if someone all they care about is break-even, we can give them an earlier break-even, but they may be sacrificing on long-term, potentially. But there's also exceptions to the rule. Like there's a world where your break-even is early, you have more cash value, the most flexibility, and death benefit is competitive. Is that a true statement, or are you always giving something up if you have early break-even?
From what I see from a give and take, if you have a break-even specifically with, you're comparing company to company, you will probably be giving just a slightly difference, like giving up something slightly. If you have comparing one company to another company, it's hard to say specifically. There's just too many variables involved. And because everybody's term riders are going to be different. Everybody's paid up positions is going to be different. Everything is different. So I would just say in general, the rule of thumb is higher earlier break-even points typically are going to mean higher early rate of return, and you'll still get long-term performance, but that doesn't necessarily always mean it's going to be long-term bad performance by any means.
It's just, if you waited a year or two, it could be better.
Yeah, exactly.
Is the reason because we're adding an additional term insurance so that we can fit more in the PUA rider, and that additional term insurance gets less and less efficient the more older we get? Or what is do you have a theory behind why that's the case?
The companies will, I think, like for instance, there's one company that has a product that's called higher early cash value.
Yeah.
And when they do that, what's essentially saying is that the expenses are getting prolonged later on in life. And then there's not many expenses at the beginning. I think there are certain companies that we have another company that you'll see the break-even point happen in year 4, and you have high early liquidity right away. But they then just don't have the same long-term performance as some of the other companies that do break even in year 6. And the companies that break even in year 6, you just can't get it to break even at year 4, no matter what product they have. And so there's just so many different factors involved, and it's just depending on what it is that you want, the company you want. There's direct recognition versus non-direct recognition that plays a factor into it. The company's long-term dividend, there's so many factors, and it really comes down to what it is that you want. Because if I'm a business owner or a real estate investor, maybe I will definitely take the break even in year 4, knowing that I will have less cash value later on in life because I care about the control right away.
Yep. It's not to stereotype, but a lot of business owners and real estate investors will take a little less money on the back end to have earlier access to capital, because the opportunity cost of them having extra capital is actually better in the long term, versus people that are using life insurance as a bond alternative or a retirement safe asset usually are not as concerned about breaking even in the first few years. So that's again,
exactly it.
Take that all with a grain of salt. Don't sue us. if you have questions about life insurance, we want to hear from you. You can comment down below. And I mean, we're in business of working with people. So if you're advisors and want to learn more, we have a link for you. There's a lot of exciting things we're doing here at BetterWealth in just educating people, but then also helping people elevate their game as it relates to showing up more powerfully via the internet. And obviously, we work with people all over the country that want a specially designed life insurance policy, which we call the And Asset. Is there any other questions or thoughts that you have as it relates to overfunded life insurance, break-evens? Is there any questions that weren't asked or weren't stated?
No, I think we had a pretty good conversation, dialogue into it. I'm curious though, is this video going on the Better Wealth channel or is it going on the And Asset channel?
The And Asset channel. And so
good.
this is just in full transparency, like we just get in the studio and I said, Dom, we're making a video, and he's like, okay, and he sits down and I hit play and we go.
And I just wait for him to say like what the question is. I'm like, what is he gonna say?
Yeah.
And then I just go with the flow. Like, all right, here we go. This is what we're talking about today.
So you can give us tips. I know if you're telling me to bulk up, I already know. Especially as I have to sit next to Dom. Yeah. So, anyways, other than that, I mean, you can still encourage me with that. But if you have any other questions, thoughts, concerns, tomatoes, if you think we're the scum of the earth, you can comment all those things because it helps our video get seen by more people.
Or don't.
Or don't. But have a great rest of your day. Subscribe to this channel if you want more content on life insurance.